Good evening and welcome to the Trading the Tech Show. My name is Derek and this is iLi Academy. Today is Monday, January 18th, 2021. And so we've had a bit of an eventful start to the week here. Lots of good things kind of happening at this point in time. The market is giving us some interesting scenarios. We're going to take a look at some of those tonight. I also had a question from one of our new subscribers. And so I want to kind of address that as well and maybe give some examples of, my theory on that as well. So we're going to jump right in. Hopefully we will survive this session because over the last probably half hour or so, we've been getting these intermittent like power, not even outages. It's just like the power just kind of like keeps dipping. And so my computer's been shutting off. So I've kind of got everything off that I can keep off at the moment to try to keep, some of the power just for the laptop. I don't know what's happening, but it's been going on like that. Every once in a while, we go through those situations where the power is just not that strong coming in. So if we get cut off, then I do apologize for that. But the Dow Jones was off 177 points today, which is really interesting because that's exactly kind of where we saw our futures this morning. It did dip a lot further near down, almost close to 30,600 today, but it did recover back above 30,800 to 30,814. So with that recovery, we've been seeing some changes in direction or some movement back towards our preferred trends on our charts. And so we talked about that a lot last night. So we're going to go ahead and take a look at that again here tonight. So for the sake of time and because of the electric situation, I'm just going to get right in and we're going to do some analysis and kind of see where we are as we're kind of starting to set some direction for the week. Now, Aussie CAD, we're on this 30-minute chart here. We're looking at our 720 here coming across the middle. In contrast to yesterday or last night's, we are actually trading above yesterday's trading day. We actually traded down below our 720, but then now we've rebounded back above the 720. Now, remember when I said our longer term moving averages, when they're above the 720, there's a real opportunity that the rate might actually jump back over the 720 and continue on in the direction of the preferred trend, the preferred direction or where the overall trend is heading. And we pretty much figured that out by looking at our 200 and our 100. Those are our longer term moving averages. Our 720 is our really, really long period moving average. But as far as direction, we're looking at our 200 and our 100. And both of them actually on this Aussie CAD stayed above the 720. So, like I said last night, we typically are going to be conservative and we want this rate to move well above the 720. So we drop our buy order here on our 200 as our opportunity to get in. So I'm going to right click and add a buy stop there on the 200 itself. And if the rate never gets that high, then fine, it just never goes that high. But if it does, then we're still above our 720. All the moving averages should revert back above the 720. And then our momentum should be to the upside. That's the most probable thing that could happen. Doesn't mean we have a crystal ball that's going to tell us, but that's the probability. So that's what I would do for the Aussie CAD. Moving on to the Aussie Yen, you can see where over yesterday's trading, we did drop here below the 720 again. Remember we talked about this yesterday, I think too, we talked about this breakout bounce type opportunity that we had here. And so it did actually trade below this low. We actually bounced a little bit over here, but then we were sitting right on that 720 and we traded below the low. So even if we, had placed an order up here, remember we drew a rectangle in here for the breakout bounce, we would have never actually been entered into that trade because we never would have hit the bottom entry for that trade. So we would just delete that particular order. So, but we can see now that our rate has reverted back above the 720 and it's headed up here towards our 200. So we could really place an order here to buy, a buy stop here on the 200. And if it reaches the 200, then our anticipation is that it should continue on to the upside because it's above our 720. Our moving averages, you can see that they're starting to turn up here. Our 8 has already jumped over the 720 because it hugs the price really closely. And our 50 and our 21 are still kind of hanging out below, but our long-term moving averages are above the 720. So I'll drop that order right there on the 200. And, if it places that order and it continues on to the upside, then we've got a lot of real estate here to this previous high. Let me see. Let me move that control out of the way. Okay, there we go. And here's my crosshair. My high is somewhere up here around this 80, 81 area. So right now we're sitting here, our entry points are right around 80, 10, 80, 11. So that's a good 70 some odd pips from our entry point to the peak. So does it mean that we have to get all of them? No, it does not. We can take whatever we get, just as long as we are dropping in our profit stop loss to hold our wins, our gains. We don't want this trade, going positive and then going back negative against us. This could be a pullback, against a move lower. We don't know that. So we don't have a crystal ball. We don't have any way of predicting that. So what we're going to do is just kind of lock in our pips as soon as possible, 5, 10 pips in, we can lock in 2, 3 pips just to make sure that this trade never goes negative, and just let it run, and then we can move the stop loss as we go. So one of the questions that we did get, so maybe it's a good time to kind of cover that too, so make sure that we kind of get to it while we're recording here and while we have power, is what is our risk reward ratio? And I don't do risk reward ratios. I talked about that in my book, The Mind Control for the Forex Market. I wrote about that. I wrote that book actually in 2015, and I revamped it last year just to kind of modernize it a little bit with some of the technology we have now. It's been on Amazon for quite some time as well, for the Kindles too. So, but in that, I talk about certain myths. I talk about the myth of the stop loss. I talk about the myth of the risk reward ratios as well. So my issue is this with the risk reward ratios. Let's look at this trade, this Aussie yen trade. Now we know that it has potential to go up here to the top. I'm going to actually draw a line. I'm going to take a line and draw it kind of up here at the top, right around this 80, 82, 80, 83 area. That's perfectly fine. It's just for illustration's sakes. So we know our entry is going to be here, kind of where our 200 moving average is sitting, 80, 10. So the potential is that maybe we have somewhere around 70 pips, 70, 72 pips between our entry and this high. So if we say, okay, so my ratio is going to be 3-to-1. So I'm going to take that 70 pips and divide that by 3. And that means that I should have a 23 pip stop loss. So I'm going to go ahead and draw in the 23 pip stop loss. Let me go ahead and grab a crosshair. 83.10 or so. We'll just call it 83.10 just for round numbers sake. So 23 down is going to put us right around 77, right? Right around here is where our stop loss would be. So I'm going to go ahead and drop a line kind of right around in that area. We're going to make it 77 even. All right, so let's say this white line is going to be my stop loss here. So I'm basing my stop loss that I'm willing to take, the loss that I'm willing to take, based on what I think my potential win should be. But how do I know that I'm going to get this 70 pips? I don't know that. I have to artificially predict that this trade is going to run 70 pips. So it's kind of setting an expectation that there's absolutely no way that I have any, any type of information that tells me that that's how far that trade's going to run. But what I have done is set an exact location which shows a pain point for my trade. When I say a pain point, that's the point at which I've told the broker that I won't take any more pain past this point. I don't want to take any more of a loss past this point. Once it hits that point, I want to get out. So what do you think is going to happen? If this doesn't reach, its goal, or maybe it comes up here and it gives us a few pips profitable, maybe say 15 pips, say it goes 15 or 20 pips profitable, and we're waiting on 70. And we don't move in a stop loss. We don't break it even. We don't break even plus pips or anything like that. We're waiting on 70 pips. What happens when it goes back negative? Then we have to keep waiting. If it goes back negative, is it more apt to hit this stop loss, or is it more apt to continue forward and go and hit our take profit? Is it going to hit our limit? No. So it's going to be confusing for traders. It introduces that confusion because now it's like, okay, I did the ratio. So, and I know what the potential of my trade is. So my stop loss is predicated on the amount of pips I think that I should gain in this particular trade. But that number is just arbitrary and artificial. There's nothing guarantee you that level of trade. So, but you are guaranteeing the broker that they get your money if they hit this stop loss. So why would you do that? That it doesn't make any sense to me that we would create that artificial expectation. And how many of your trades go 70 pips? Think about it. Think about with traders that are trading in the market today, what percentage of their trades are actually going to do 70 pips? Think about that. People are happy getting 10 pips, 20 pips. Their ratio is blown away, right? There's nothing wrong with taking profits. Even if you say you set a ratio and you took profits at 10 pips or 20 pips, that's actually probably the best thing that you could do if you're going to treat, your trading this way. If you're going to trade with a ratio, that's the best thing you can do. Break even very, very quickly and then let your trades run. Because other than that, chances are you're going to hit that stop loss. Any stop loss that's within whatever the average true range is for that particular pair for the day is fair game to be hit by the broker. It's not a huge distance for them to travel to kind of hit this stop loss here at 79.77. Not only that, all the moving averages are facing kind of to the downside as well. Even though we're trading above our 720, the moving averages are in order to the downside. So there is some potential for momentum still to the downside until all those moving averages kind of change location and start to point up. Right now they're pointing down. So you're putting yourself at risk here. Even though you're trading in the preferred direction, you're trading above the 720. We're doing all those things right, but we're introducing something that could, destroy the trade before it has a chance to take off. Nobody says it's not going to move in a straight line. So this rate could come back down here, retest the low again, right? It could arch over, come down, retest the low again, and keep on going down. But before it could even test the low, we've got that ratio in there. We've got that stop loss in there based on a ratio that's artificial. So this is the reason why I say I don't trade with ratios like that, because it's just an arbitrary stop loss that you're placing based on the idea of fear. Because, if you look at anybody who's telling you to use a ratio, anybody who's telling you to use a stop loss on your trades, 9 times out of 10, the only reason they're telling you that is because they're telling you because that's what's going to preserve your account. That's going to keep your account from getting liquidated. That's going to keep you from losing too much on a trade. That's what they're telling you. They rarely ever talk about lot sizing. They rarely ever talk about, what margin you're actually using, and using your margin and lot sizing in a way that if every one of your trades is negative, your account's still not in jeopardy. So this requires, so our philosophy requires something a little bit different. Our philosophy requires lower lot sizes. It's going to yield lower gains on each of the trades. It's going to be less money per pip, but at the same time, you can have every one of your trades on your account go negative and you'd still be able to survive. Not everybody can say that. You see a lot of the traders that look on Instagram, look when somebody's posting their trades, or maybe they've got a screenshot of their MT4 or something like that. Look at their positions. A lot of times it's 5, 6, 7, 8, 9, 10 of the Euro US. They're all the same position, and they're all at different rates. They've come in at different rates. Some of them just fractions of a pip apart, and they even sometimes different size. Sometimes they're all the same size, lot size, or other times they'll be all different ones. I have one on my Facebook timeline now, and I'm trying to figure out what they're doing. I look all the time, and I see sometimes it's like 0.1, then it's like 0.2, and then there's 0.7, and then there's 0.8, and they're trading the same pair. And it looks like as the trade goes negative against them, they start adding to the position. They start adding bigger numbers to the position. And the idea behind that, I know, is that the further it gets away, it's like now you're thinking in your mind, well, it can't go that far. away and it's got to turn around. So I'm going to put a bigger number. And when it goes back towards my original trade, it's going to accelerate, and it's going to accelerate the wins for me. And it's going to, make sure that my account goes, positive, or at least that position goes positive on that particular currency pair a lot faster. So I get what they're doing with that, but it's dangerous, because what if it doesn't? And now you've added like this 0.08 trade on when you really should be trading like 0.1. Now you're like 8 times as likely to, you're losing 8 times the amount of money on that one trade. And that's not even all the other trades that you built into that. So, your account shouldn't ever really look like that. And it's amateurish, and I see it and I go, they're teaching people, and they're either charging money or giving away this information for free. And they're doing it. Some of it's an auto trader. They have an auto trader that's apparently doing this as well. And yeah, people are making money, but last week everybody was groaning and complaining, and everybody's, crapping a brick because they're losing money and the drawdown is so high, and they just weren't used to it. The market doesn't always stay the same. So yeah, it's good at one week, but then the next week when it's not good, what do? Are you confident in your positions? Are you confident in what you've taken? Can you withstand that drawdown, putting all those multiple positions on your trade? To me, you should have a trade strategy that's going to tell you exactly where you get in and where you get out, and there shouldn't be multiple entries. And I look at the entries and I'm like, okay, some of them are like 0.02 of a pip away. Some of them are like a full pip away. Some are, they're just, some are 5 pips away. Some might be 10 pips, and they're just adding on. They're just kind of scaling into this position. And it's like, what is your strategy? What is your real strategy? Because why are you getting all of these different entry points? That tells me you don't really know why you're entering. You're entering on hope. And that's where the gambling comes in. That's when you're gambling, because you don't really have an entry. You're just deciding which direction the market should go, and you're piling in, hoping that occurs. That's not what we do here. That's not what I'm teaching my traders. I want my new traders to be extremely confident about why they placed an order. 2 years from now, they're going to look at this Aussie yen chart, and they're going to tell you exactly why I placed that order at 80.10 or 80.11, whatever it is. They're going to know exactly why, because this moving average is going to be sitting exactly here. This rate is going to look exactly, the candlesticks, except for this last one, are all going to look exactly the same. We're going to see that the candlesticks were below our 720. And as we went back above the 720, we passed our 100, we passed our 200. So that tells us that the preferred direction was still to the upside. Even though we pulled back against trend, the preferred direction is still to the upside. And that's the reason why I would have placed this trade conservatively on the highest moving average, where the rate would have to move over the 720 and travel the furthest before it would put me in the order. So I could walk through that at any point in time from now into the future and be able to tell you exactly why I entered that trade. And that's what I want for my trader, because then you don't second guess what you're doing. You never have to second guess whether your order, that you placed is correct or not. You just walk through the steps and go, oh, okay, I made a mistake. That's not what I should have done when I walked through the steps. This is not where I should have placed this. Or this is exactly where I should have placed it. That's the difference between a successful trader and a trader who's not successful. It has nothing to do with money or how many wins you make. A monkey could pick a trade and win. Why? Because the market only does 3 things. It goes up, it goes down, and it goes sideways. The market only does 3 things. You have to be like 33.3% correct, in your guess. So anybody could guess, right? So it's like free throws or whatever. Like, you don't have to be a professional basketball player to hit a free throw once in a while. You don't have to be. You probably can hit a couple, right? Out of 10, you're probably going to hit at least a couple, right? So, people get enamored with that. Like, they feel like, okay, I'm doing this the right way, or I'm successful, or I'm winning. And that proves everything. It doesn't. What proves, whether you're a successful trader or not, is whether you can follow the disciplines. If you understand exactly why you're entering a trade and you stick to your disciplines. So ratios, they're taught. I haven't found anybody that's explained it to me in a way where it works and it's not random. Now, maybe one day I'll find somebody who can explain it to me and I'll go, oh, the light bulb is on. But for the longest time, like whenever, I'll just preface what I'm saying here. I worked for a trading company. I worked for a Forex trading company. I worked for on trading desks in the equities market. The equities market, just forget about it. It's not even close. We had millions of dollars in positions. We never did any of the crap. We never even looked at a chart. So, it's a whole different ball game when you're trading that. But on the Forex side, I've worked in I worked in a software company that made software for Forex. I did radio shows like this on a daily basis, 2 radio shows a day, and I coached individual traders. That was pretty much my job the rest of the day is, to do their classes for them. They'll, just like this, we do it online. I walk them through, say, here's the strategy. This is what we do. This is what you need to do. And we had a lot of success with that. A couple of strategies and things that we wrote is very, very good. So, that's some of the stuff that I'm bringing here. So that we can continue to do the same thing and we can have people be successful with it and be confident at the same time. So the risk reward ratios, all of that I tried. I tried the stop loss. I've tried it in different ways. When we could hedge trades, I tried hedge trading. I had someone build me a whole spreadsheet that could give me, the exact points where I should hedge at and things like that. And we tweaked it and tweaked it and tweaked it, and it just never worked. It just was not a viable thing to do in the real world with the markets, fluctuating the way that it does. So, just over time, you start to look at it and go, okay, I've tried this, I've tried that, I've tried this theory, I've tried that theory, and I can't make it work the way they're telling me that it should work. It just doesn't work that way. So this is one of the reasons why I'm going to get off the soapbox here because we need to get through some more charts. But that's the reason why I don't like risk reward ratios. I think it's artificial. I think it sets an artificial spot where you're telling the broker that you have a pain point. When it gets to this point, I'm going to tap out. I want you to take my money. I talk about that in my book too. So if you ever get a chance to read my book, read the Mind Control for the Forex Market book too. Short 26 pager or whatever like that. I can always send it to you if you want it as well too. It's on the website too. It's on Amazon, a couple other things too. Aussie, New Zealand, let's take a look. So from last night, not a whole lot has changed, but we did get some opportunities here. We did see that our 720 is way down here, right? So our rate and our moving averages are above the 720. Yesterday, in yesterday's trading, we did get some pullbacks to the 50, but not quite enough for us to really place an order here. If you were using the 21, you probably could have had a couple of trades that were nice and that worked out for you. At the end of the day, we did actually trade down here to the 100. I didn't get a chance to see it. I had another class that I went out and did tonight. So I didn't get a chance to actually watch this occur. I don't know what the spread was like when this occurred because it was right at the turn of the day. But if we did trade down here to the 100, we could have dropped an order here on the 50 to buy, at that time. And so, we would have had a profitable trade. And like I said, it doesn't always go 60, 70 pips. It might only go 10 pips. We lock it in and we just let it ride until it either crumbles or, or it hits a stop loss or it just continues and takes off. We just let it ride. So we're just waiting again for another opportunity for the rate to trade down here past the 100. And once it does that, we can drop our order on the 50. Here's the Aussie US kind of doing the same thing, right? We've got our 720 coming right here across the middle. We've got our moving averages starting to turn up a little bit. The 21, the 8 is actually meeting the 720 right now. The 50 and the 21 are still down here. They're kind of turning up right now. If the rate continues to the upside, then yeah, we should get a move to the upside and we should get those moving averages jumping back over. So what I'm going to do is right click right here where the orange 200 is. I'm going to go to trading, buy stop, and place that order to buy on this moving average. Doesn't have to be quite exact. You can get it kind of close there, just as long as it's close. I'm not the kind of person, I don't care about the little fractions of a pip or whatever. Some people are like, really greedy like that. I could care less because I've got trades that happen all day long for me to make money. I'm not going to, wig out over like a fraction of a pip or something. It's just, I'm not attached to money that way. Aussie US buys, our buy is right here. That's where we would place it. And we can see that we're headed up right above our 720. Now, you might look at it and say, okay, my 720 is down here at 76.96 or so. My 200 is here a little bit about 77.15 or so. It's about 20 pips or so. That's enough room for me to say, okay, there's some type of confirmed movement above the 720. But anything less than that, maybe about 15 pips or lower, I'm going to be a little cautious. If the 200 sitting down there about 15 pips away from my 720, I'm probably going to walk away from that. I don't care what happens. Let it set up to the upside, and then we'll see what opportunities present themselves on the pullbacks. So that's kind of my line of demarcation there of when I'm going to place that trade. CAD yen, we jumped over our 720 as far as the rate, but all the moving averages are below, right? So in this situation here, I'd look at probably my lowest moving average, which is going to be my 50, the one that I trade on. My 50 and my 100 are sitting here around this 81.34 area. So I'd right click here, go to trading, and place a sell stop, because my long-term moving averages, my 200 and my 100, are still below the 720. So it doesn't really matter to me that the rate has jumped above the 720. It's kind of headed up, yeah. What matters to me is that this is the preferred direction to the downside. We had a full mature trend going here to the downside. Now, can it change? Absolutely. I'm not here to change the market or tell the market what to do or what I think it should do. I really don't care what the market does. I'm just here to capitalize on what I see as direction. I don't care what direction it's going in. I need to capitalize and trade in that direction. So if it's jumped above, the rates jumped above the 720, maybe it's just pulling back at this point. Who knows? It may jump back over the 720 to the downside and want to continue on down. If it does not, I delete this order. I watch my moving averages jump over the 720 to the upside, and then we wait for pullbacks to buy. Swiss yen, not quite there yet. The rate didn't quite jump up here to the 720, right? So we've still got our moving averages pretty much in order to the downside. The 8 is kind of turned up past our 21 and our 50, but that's okay. We're pretty much in order to the downside here. We've got a nice head of steam to the upside. We've pulled well past our 100. So if I'm placing an order here, I would drop my order on this 100 to sell. Oops. I don't really need my depth of market here. What I need to do is I'm going to right click here, go to trading, and place my sell stop. About 116.54 is the area where I drop my sell stop. Now, if this rate continues past my 200, maybe by about 10 pips or so, it jumps up here maybe near this 720, I'm going to take this order and just slide it up and improve it maybe to that 200. Because all of the moving averages and the rate right now are below. My preferred direction is to the downside. So with this strategy, it's not requiring you to manhandle the market in any kind of way, or have to play some Jedi mind trick on it to get it to do what you want it to do. You let the market do what it does, and then you kind of adjust to it. I always talk about being a ship captain. I've talked about that in some of our other shows. If you're a ship captain, all the passengers want you to do is get you to their destination from dry land to dry land. But the reason why they hire you is because you've been out there on the water before, right? You understand what you're up against out there. And if something happens, you got ideas for what to do. But you are still, whatever you're doing, you're still headed to your destination. You might have to take a U-turn, or not a U-turn, but a detour is the word I'm looking for. But you're still going to be headed towards that direction. You know how to get around the storm, maybe, or whether, not to, venture into the storm. You know how to deal with those things, and you know what to do in those situations. You're going to be the calmest person on the boat because you've been in those situations. You've got the experience. So that's, kind of my job as a trader, is try to give you that calmness. And as you come with me, and as you're not even passengers, you're my crew members, you're crew members, you're all, manning your boats, and we're going as a fleet, and we're moving in the same direction. That's the way that we roll. So, we can't control whether the storm comes. We can't control the weather. We can't control how large the waves are going to be. We don't control any of that. We just take what we get, and we process the information, and we find out what's the best probability for me to be profitable in this, right? So here we go on the Euro Aussie. We're trading below our 720, right? Trading, everything's below the 720, the moving averages, the rate is below the 720. We did trade up here past our 200. And so we could have dropped an order. We were well past the 200. So we could have dropped an order on this 200 at some point between like half of yesterday's trading and now, or the beginning of today's trading. And we would have had a profitable order already, right? Even if we had dropped it here and we got involved in this trade, had we used a ratio, we might artificially place a stop loss up in here that maybe got hit just because it's an order that's sitting out there, and that's the job of the market maker. He's supposed to hit the order. So he's looking out there and going, oh, there's somebody who wants to trade out here. So I'm going to trade out there for him before I move the rate to a different place. And they might go up and hit your order for that reason. And people used to call it stop hunting. I don't see it as much. Maybe I'm not in the forums as much and things like that as before, but that used to be like a huge term for us, stop hunting. Oh, the brokers are hunting my stops. No, you're putting them in harm's way by showing it to the broker and telling him that you want to trade there. All the broker's job is to do is look and find trades. They don't have time to look at your account and say, oh, I want to hurt this person's account, or I'm trying to kill this person's account. They don't know what it's going to do to your account if they trade there. You placed an order there and they're like, okay, my job is to fill orders. As a market maker, you're getting paid on the spread a lot of times. So if they've got a seller and you're a buyer, then they're going to match those orders, and they can match it. They're going to match those orders. If they've got a buyer and you're the seller, they want to match that order because they're getting paid in the middle. They get paid the spread in the middle. So they don't really care what your account's doing or whoever's account, whatever. If they got an order out there and there's a way to hit that order that's going to help them, execute, the order on the other side that they're doing for the other trader that's on the other side, they're going to match that order up. And yeah, they might hit your stop. So don't set places where, your trade's going to get killed, by telegraphing that to the broker. That's not what we want to do. I know it's like literally the first thing everybody learns is to place a stop loss order. And it's literally like the worst piece of advice you could ever get, so it just boggles my mind, that it's even still around. And I think some people are starting to embrace it because I'm starting to see more videos and things, people saying, oh, how to trade without a stop loss, how to do. Yeah, they're starting to get wise to it because it's like, okay, you're setting yourself up for failure when you do that. Or you've got a stop loss so far that you might as well not even have it anyway. You're going to get liquidated. So because they don't know lot sizing. So, it just becomes a mess. Anyway, Euro Aussie, we're trading below our 720. All the moving averages are below the 720. They're not in order yet. They're kind of a mess here, but we could have still placed, it's so far below the 720. 720 is not even on the chart here. So we could have placed an order to short on this 200. Had we done it later on, we could have shorted on this 50. Just depends on what time you actually saw the order occur or saw the setup happen. And any one of those trades, the 200, the 100, the 50, any one of those trades would have been profitable right now. Every one of them. Euro CAD. Here's one that I'm actually in. I think we set this trade up last night too. We're trading well below our 720. We see the rate did jump up here above the 200. So I dropped my order to short here basically on the 100 moving average, which is in yellow. And we did come down and get placed into that order. You can see it fluctuate a little bit for a few hours, but now that order's profitable. It's in the preferred direction. So I'm not worried about it. I haven't broken it even yet. I probably will at some point here. I'll probably create a break even. Well, let's actually do that right now. I'll just right click on it or double click on it. And then we'll place an order maybe around 54. Let's just see where that sits. All right, and there's my stop loss, right? So I can have it sit there. It doesn't really matter to me. I can move it up here, maybe sit it on the 50. I'll sit it on the 50 because this signature effects trader, auto trader, it actually uses the 50 as and the 100 as moving averages that where we place our stop loss after we go into profit. So I'll just place it on the 50 and I'll just leave it there. It doesn't matter to me whether or not it goes back to the stop loss, as long as I'm going to get my money out of it. I'm going to get paid out of it, whatever, the opportunity though, is that it will continue on down. Now I do have this artificial take profit here. I just kind of placed that in there today because this is a place where we were seeing some support going on here. We did see some support here. Here was acting a little bit as a resistance in the same place. So I figured that's probably a great take profit area. right there. So it'll get us out of the trade. I don't really care as long as I got some pips out of it. I don't need every pip on the board. I just don't. I've got so many opportunities to trade that just won't matter to me. It doesn't matter to me. There's always going to be the next train. Euro Swiss, we're trading below our 720. All the moving averages are below. The rate right now is above our 100, but it's a little close to the 100. So if I'm placing an order, I'm going to use my 50, right click, go to trading, sell stop. That's how fast you can do this analysis. Euro pound, we're trading well below our 720. Our rate now has pulled down. It did pull back past our 200 before, so we could have placed it either on the 200 or the 100. If we had done that, we would have a profitable trade right now. The 150 are in the same area, so we would have had a profitable trade right now. So we've got to wait on pullbacks for that. We'll see what happens there. We see the euro yen is kind of pulling back now against the trend. We had a full trend to the downside. Everything is below our 720. We've pulled back almost to the 200. So if we're placing an order here, we're going to right click and place it and put it on my 100 moving average. Now, as the 100 moving averages improves, I'll go ahead and move. I'll go ahead and move the entry order. I'll go ahead and move it. So if it jumps up here, if the rate jumps up here above the 200, I'll move the entry order to the 200. I'll just improve that order. But the big thing is allowing the rate to go my direction before I get involved in the trade. If it doesn't ever go my direction, I don't get involved. Euro New Zealand, we're trading here now below our 720. The rate fell back below the 720. All the moving averages now are below the 720 as well. Even though they were pointed to the upside, the preferred direction is to the downside because our larger moving averages are all below the 720. The 200 and the 100 are below the 720. So now we should be trading to the downside. So we could have dropped an order either on this 50, the 50 is kind of close to the 720 though. So probably on this 100, I'm not going to chase it now. I'll place my order here on the 200 to sell, right? Because that's the furthest one away. It's got to commit to that move to the downside before it actually involves me in the order. It's not far away from where we are now. Our Euro US, quick analysis, we're below our 720 moving averages and rate. The rate is just above our 100 right now. So I'm going to drop my order here on my 50 to sell because I'm bearish, right? That's the preferred direction. If it doesn't come back, I'll improve the order and then eventually delete it once we jump back over the 720. Pound Aussie, we can see that our 720 is kind of coming across the middle here. Everything's above the 720 except for our 200 moving average, which is still kind of here on the bottom here. So I kind of, will look at this and go, I could place an order here on the 200 to sell because that's the longer term moving average. And so it's still giving me some preferred direction to the downside. Now my 100 is above the 720. So if that makes you shy away from taking that particular order, fine. But indeed, if the rate really and truly is going to continue off to the upside, it's probably not going to break this 720 by much. It's already tested it a few times here, and that proved to be a support area, and then it went up. So I'm figuring here maybe it'll hit that 720 and continue to bounce. If not, and it falls through the 720, then there's an opportunity. There may be that opportunity that we may continue to trade to the downside here, and that's why my 200 would be out there. As far as the pound CAD, we're trading above our 720, right? But our moving averages are all flat together. We're trading off to the right. Remember, I talked about the market only doing three things. It only goes up, down, and sideways. You're looking at a little bit of sideways going on here. You can see in the moving average how this is just really kind of flat on our 200, our 100, our 50. It's really just kind of flat in the same area. The other moving averages have kind of fluctuated a little bit, but right now, they're just really consolidated. I don't have anything going there. I need this to open up and start showing me some distance between the moving averages first. Pound Swiss, we're trading above our 720 here. We can see that we traded well below our 200. So we could have dropped an order here on the 200 or on this 100, even on the 50. And either one of those trades would have been profitable for us. Just takes a little bit of patience. Pound Yen, we can see that we're trading above our 720 now. So the rate did jump below, But then the long-term moving averages, they were above, right? So dropping this order conservatively on the 200 would have been done what for us? It would have given us still a profitable trade because we had to have the rate move in our direction before it would have picked us up on this 200 and kept going. So, don't be afraid of that. Don't think that, wow, that's kind of far away. It can happen. It happens all the time. So, how many people do you know that would have seen this move here and seen these moving averages and would have shorted here? There's a ton of people that would have shorted here and they have no idea why this trade turned against them. Because number one, they're going to wait for this move just about to exhaust itself before they go in short, because they wanted to confirm, to confirm. Every time one of these green candles hits, they get a little bit scared. Oh, it may go back the other way. It's going to go back the other way. Oh, no, it didn't. It dropped down further. Okay, well, maybe I'll get in. And then a green candle comes and they get scared again. But we can look at this and say, I knew what the direction was all the time because I knew my moving averages were above my 720. I didn't have any confusion about what direction we should be trading in, right? So there's a lot of people that lost money when they technically really shouldn't have. Pound US, we're trading above our 720, rates above the 720. The moving averages are all above the 720 now. We still had that dip yesterday. So same thing. We had this big move down and a lot of people caught that falling knife, right? Because they didn't realize that the real preferred direction is still to the upside. That's what the long-term moving averages are saying, right? Let's go here to our New Zealand CAD. Our New Zealand CAD is trading below our 720, right? For a while there, all the New Zealands were trading to the upside, and now they've kind of changed directions here. So we've got this trade all below our 720 here. We've pulled back a little bit past our 50, not quite to the 100 yet. So, so not quite far enough to actually drop our order to short here on the 50. I don't use the 21, but you could if you wanted to kind of be a little more, less conservative, I guess. You could use our 21. But for me, I'm not going to force that order. I've got plenty of things that, plenty of orders that I've already placed that might have a little bit better opportunity for me. New Zealand Swiss. So we've got kind of the opposite thing going on here, right? So we've got our 720 kind of shooting through the middle here. We've got the rate trading well below the 720. And now our 200 is trading above the 720 as well. The 200 is sitting above the 720. So I don't want to place an order to buy here because it's really close to my 720. I'm just going to wait and see what sets up. If this moving average jumps below my 720, then great. Then maybe we head back down here. But overall, I'm looking at the 720, sitting below my 200, and I'm saying the preferred direction still to the upside for me, because the long-term action is telling me it's above the 720. That rate should be above the 720. Now, the New Zealand yen is trading below the 720. Our 200 has actually jumped below the 720. So all the moving average are below the 720. We've traded above our 100 moving average now. We've traded probably far enough above it where I would basically place a sell order on the 100 itself, because we've got enough distance here. We're about halfway to our 200 here already. So I'm going to place that order to sell. If it goes back into that direction, then it should sell and come, pick me up on the 100 and take me down further. New Zealand, US, kind of the same thing, only we didn't trade quite as far above the 100 just yet. So, maybe our opportunity is going to be here on the 50. So we can right click there, trading, sell stop on my 50, because everything's below my 720. So, and we're trading lot size. We don't have to worry about, placing multiple trades and all that type of thing. We don't do that. We place one trade. We place one trade and we go with that. US dollar CAD. We talked about the US dollar CAD last night. What did I tell you? I told you the dollar's been weak, right? The dollar's been weak forever. So even though we got this nice move to the upside, in my mind, I was telling you, I don't want to buy into the dollar, going higher, because the dollar's been weak. We're at, 2-year lows or whatever. We dropped like 2% in the dollar already. So, over the last year or year and a half or so, we've dropped like 2%, in the dollar. So my perception here is that we would short basically on this 200. That's probably what I would have done. in this situation, even though the rate was above the 720 and some of the moving averages jumped over. I'm not gung-ho to buy up there. I'm a seller of dollar. So, and here we go. We dropped down below our 720 and we've hit our 200 here. And so, my anticipation is that we continue on down. That's just the fundamental of it. I mean, the fundamentals of the United States, monetary policy has not changed. So that means that our direction is probably not going to change. So that's the reason why trading Forex is not gambling, like some people tell you, because it's backed by monetary policy. It's backed by the Fed, Federal Reserve banks, and all of the other, banks around the world. These large banks, those institutions are setting monetary policy, which sets direction of currency. So this is why when people say, "Oh, trading is gambling," it's really not. It's basically analyzing information, analyzing economic information, and then trying to figure out, well, what's the direction of the monetary policy for the particular country or currency you're trading. There's a lot of data that's behind it. It's not rolling a dice, right? So that's kind of, how you combat that, because there are going to be people that tell you that it's gambling and it's not. US dollar Swiss, you can see we're trading well above our 720 here. We've got our moving averages pulling back now towards our 100. So we can drop our order to buy on the 50 if you're going strictly by this particular chart. I'm not a buyer of dollar, so I'm not interested in placing that trade. US dollar yen, we actually traded down here below our 720 as far as the rate, but the long-term moving averages were above. The 100 and the 200 were above. So even if you had placed an order on either one of those to buy, you would have a profitable trade. Look at that. That's the preferred direction. That's preferred momentum. That's what happens. But I'm not a buyer of dollars. So I don't care what it does, because I'm not a buyer of the dollar. I'm just not interested, because anything that's a dollar major, I'm not interested. Now, it's a little different with the dollar yen, because the yen is a safe haven currency as well. So, when things are not good or things are not looking up, the dollar and the yen are safe haven currencies. I think the yen probably all more so than the dollar. I think, in my mind, it's the yen more so the dollar than, that I think of it, because I think of in the US at a safe haven more in gold. I think gold is the safe haven more so than I think of the dollar. And that's why when the market drops, you have a rise in the price in gold, because people are leaving the market and placing orders in gold. But you can see here, even if you just did the strategy the way that it's written, you would have been happy. You would have been happy because you're profitable. You definitely got a profitable trade going on here, maybe 20 pips or something right now or whatever, and you'd be happy. So the strategy works. You don't have to force any trades. You don't have to take any trades you really don't want to take, or try to force one in. You don't have to. You've got lots of opportunity that we've seen tonight. So I'm going to go ahead and get out of here. I hope that you enjoyed the show tonight. I'm just lucky that we got through with the electricity and all that stuff. I'm really happy about that. So I'm going to go ahead and close out here and win while we're ahead. And if you have any questions or concerns, definitely contact me. I'm definitely here. And if you need my assistance, or you have people that want to come on and join forces with us or come on board with us, let them know that we're here. So I'm thinking of doing a promotion where, anybody who's coming to us right now, maybe we can do some things with them to bring them on board. I don't know if you have, questions or concerns, definitely contact me or whatever. Right now we're running I think it's a 15-day free trial for manual traders to come on board and get our shows on a daily basis and have access to the information through the website and the training and all that. And it's after that, it's like $1 a day. So it's basically like $30 a month or whatever. And if you do like a quarterly or semi-annual, it's even cheaper than that. So you can't really beat it. I mean, you can't beat it. So we're just trying to grow the community for this year. So it's not like you can smash the like button or anything for me here. Most of our stuff, our YouTube stuff, is going to be kind of hidden from the public. It's only for my individuals who are subscribers. So I'm not double dipping there. If someone happens to find it, they find it, but this is for our subscribers. It's not for, for the general public, this information. So you kind of have to come here to get it. So once again, my name is Derek. This is the Trading the Tech Show. I wish you all a wonderful, happy, night of trading. If you have questions, concerns, contact me. All right. We'll talk to you soon. Have a great one. Bye-bye.